Financial disclaimer. The information provided in this stream is for educational and informational purposes only and should not be considered as professional financial or investment advice. We are not licensed financial advisors, and the content presented here is based on our personal opinions and experiences. Investing in stocks and other financial instruments involves risk, including the potential loss of capital. Any investment decisions you make are solely your own responsibility, and you should conduct your own research and consult with a qualified financial professional before making any investment choices. The content we share on this stream may not be accurate, complete, or up to date. Market conditions and financial regulations can change rapidly, and we cannot guarantee the accuracy or reliability of the information presented. We do not endorse or promote any specific stocks, companies, or investment strategies. Any actions you take based on the content of this stream are at your own risk, and we will not be held liable for any losses or damages that may occur as a result. Always remember that past performance is not indicative of future results, and no investment is guaranteed to be profitable. Make informed decisions and consider your risk tolerance before investing any funds. By accessing and using this stream, you acknowledge and agree that we are not responsible for any investment decisions you make as a result of the content presented. You are encouraged to seek advice from qualified financial professionals for personalized guidance. Please invest responsibly and only with money you can afford to lose.
Hey man, just found the next guaranteed multi-bagger.
Hey man, you found another one? What is it this time?
Come check this out.
Hey guys, welcome to Laughing Stock. It's a tough day. Tough day as a BNED holder. We didn't get quite the news we were hoping for today. There is a pretty massive dilution that's going to occur. So any of the bears who were arguing that there'd be massive dilution, which they did state in the one, ended up being correct. Now, the reason why I didn't think that was possible is because the amount of dilution, what they would have to do would be insane. And I was right. It would be insane, and that's pretty much what they did. So we'll go through the documents that came out today. I did have to, just to be completely transparent with my position, I had to adjust some of my things down because I was so heavily into BNED. So I did have to sell shares today in order to be able to participate in the rights offering that's going to occur. I had to make sure I had enough funds that I would be able to work along with the dilution, because the one argument you can have still is that if BNED continues to actually be successful, what they really just did was transform their balance sheet, and now they're in a much better position going forward, especially if the Department of Education, if that ruling doesn't really hurt them and they continue to grow the FDC program, they're actually in a pretty good position now, despite the fact of all this dilution. So if you're able to basically adjust your position for the new dilution that came out, as a shareholder, this doesn't totally kill you. So what I had to do, because I didn't have enough funds, I had to sell part of my position to make sure that I think it's for every 1,000 shares you have, that you'll be able to participate with in the rights. Either way, you can basically get 16 point something shares, or maybe it rounds up or down, whatever, at 5 cents a piece for every share that you have. So that's the way I did my math. I just made sure that I had so many thousand, for every 1,000 shares, I would have the money to be able to buy an equity offering to basically try to not get diluted into nothing. So yeah, it's obviously not the news we wanted to hear. I didn't get a ton of time to talk to Johnny today, and I was actually super busy today, so it was like a pain because I was trying to read up on everything at the same time. It was just a busy day. So there's a lot we'll go through. Obviously, the focus tonight will be on BNED quite a bit, just because there's just a lot to go over. If as always, this is why we highly recommend everyone do their own due diligence here. There's still a lot that could happen here. It looks like there's some new players. The company Immersion is now all of a sudden a giant equity holder out of this. They created a new ABL facility with a new 4-year. So we hopefully can look into that. And there's going to be more filings that are going to come out. So we'll have to see. but this is why Johnny and I had talked about the risk of just investing in these kind of companies, especially because we're taking large positions. So yes, this one hurts. This one hurts the portfolio quite a bit. I think my overall portfolio now with all the risk is down about 40% for the year. So it does stink because, like I said, I was up. I had two large positions go over 50%. They were almost both doubles. So this easily eliminates those gains. And you know, we had talked about the strategy earlier in the stream of selling out of these things, and this was a risk that I wanted to take on. And you know, in this portfolio, I wanted to attempt to take on more risk, which obviously it can hurt you too. So you just have to realize that, which is why we constantly say to, you know, do your own due diligence and to size your positions accordingly. Because otherwise, you know, if this was a different portfolio for me, I mean, this could kill you. So you really do have to take all that into consideration and make sure that you don't do anything that you know, that you'll regret. You know, so as always, you know, we just wanted to say. You know, for the rest of you guys who have been here the whole time, we appreciate all the help and time that you've given us. And well, I mean, it's not like things are over. There's still room to move around here, and we'll just have to kind of reassess from here, and we'll keep going. I'll probably, as things go, we'll figure out how much I want to put into the equity offering, and then that'll be kind of my set BNED position. And then we'll continue looking at other tickers, and just the stream will go on. We'll go on. I'll probably continue to weigh things going forward, but you know, in hindsight, yeah, it sucks that it didn't work out, but and not that it's not technically still going to work out. It just didn't. It sucks that it didn't work out how we were hoping. Now it's going to be a longer ball game, and there's still just a lot of unknowns essentially. So, we'll pan through here. I just have the dashboard up here. It looks like it was a somewhat red day for the markets. Coal's randomly up. But other than that, not too much moving around randomly. I saw cocoa finally took a hit. Finally. But yeah, other than that, I don't really see too much that really catches my eye in the markets today. I honestly, because the BNED news was kind of what caught my eye, so obviously. So I didn't actually look at what the rest of the markets did. But you know, it just looks like everything's kind of down. It wasn't a really great day for anything besides, I guess, coal randomly. All right, so we'll continue on here. So I had pulled up just a few pages. So they had a few filings today, kind of all in the same realm. Let me make sure you guys can see that well enough. This is the initial one here too. So it is a rights offering, and they're going to issue this. And like I said, the share dilution looks like it's going to be pretty heavy because it depends. It looks like there's multiple parties that are going to be able to get common stock, and if they're all at 5 cents, there's going to be substantial dilution that will occur. So they did create kind of a poison pill type thing here. It was kind of confusing at first when it first came out. I was like trying to understand what the heck I was reading. And you know, they're talking about the rights, and it's this is for a preferred stock. It was basically just to make sure that no one swooped in while the stock price was down this low, because obviously when you released this news, they knew there would be a dilution for the stock. And it looks like a junior participating preferred stock per value share of the company at a purchase price of $5, and that was just basically to prevent anyone from you know, that wouldn't get any voting or liquidation rights. But blah, blah, blah. And then it gets kind of onto the issuance of what's actually going to occur here and how the redemption might be done. But let's go to the next one here. So this one starts to state on April 16th, blah, 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 entered into a standby security purchase and debt conversion agreement with Toro which is Immersion, Cells Family, Outerbridge Capital, Vital Top Lids again. Pursuant to the terms and conditions of the purchase agreement, the company will distribute to holders of its common stock par value at 1 cent per share non-transferable subscription rights to purchase up to an aggregate of 900 million shares of common stock of the company at a subscription price of 5 cents per share per stock. That, if it exercised in full, will provide gross proceeds to the company of $45 million. And then this is part of the reason we were arguing that we didn't think there would be dilution, because it's still, I mean, you're offering 900 million shares and you get $45 million. It's just not a lot when you look at it like that, in my opinion. But it seems obvious at this point. What must have happened is the lenders were the ones who were basically arguing that, they had to do something like this, and they had to raise like a certain amount at first. So in order to get that first amount raised, they had to make a deal with someone, which caused initial, dilution. And from that point on, they're like, we might as well just put up a full rights offering and just get it over with, put ourselves in the right position. We'll offer something to existing shareholders, so we don't totally screw them all over. And that's kind of where we're at. And separate from the rights offering, up to 45 million in shares of common stock not subscribed for by the company stockholders at the expiration of the rights offering. The purchase agreement also provides that concurrently with the consumption of the rights offering, Immersion and Vital will collectively purchase at the subscription price in a private placement exempt from the registration requirements, and separate from the rights offering, an additional 50 million in shares of common stock. Vital Toplids will collectively convert all outstanding principal and interest amounts owed to them under our term agreement into shares of common stock at that subscription price, resulting in the satisfaction of all amounts owed by us thereunder. So that's how they work this out with them. The closing of the transactions contemplated by the purchase agreement is subject to the satisfaction or waiver of customary closing conditions, blah, blah, blah. Closing of the transaction contemplated by the purchase agreement is also subject to the approval of our stockholders at a special meeting to be held. If the issuance and sale of our common stock pursuant to the rights offering and the transactions are not approved at this special meeting, the rights offer would be canceled. I highly doubt that's going to happen. Further, the company amended its existing ABL facility to, among other things, revise certain milestones related to the previous disclosed liquidity and refinancing contingency plans to align such milestones with the transactions contemplated by the purchase agreement, which was the 12th Amendment to Credit Agreement, which milestone I, filing the Form S-1 described above no later than 2 business days. Sorry, I'm just parsing through that paragraph here. Does not report to complete and is subject to and qualified by entirety by the full text of the purchase agreement. Either way, it doesn't really... it's just saying that they amended the ABL. Says in connection with the transactions, the company's chief executive officer, Hughesby, let's see what he did. He agreed to amends to his employment agreement, pursuant to which, among other things, he agreed to a revised decreased severance amount of $750,000. He also agreed to provide transition services as a consultant for 6 months following the effective date of any termination of his employment that triggers a right to receive such severance in return for the compensation of $750,000. So that doesn't really change all that much. Obviously a lot of forward-looking statements here. Let's see here. For other important information, the issuance and sale of shares of common stock pursuant to the rights offering and other transactions contemplated by the purchase agreement is subject to, among other things, the approval of our stockholders at a special meeting. If the issuance and sale of common stock pursuant to the transaction is not approved, then the rights offering will be canceled and the transactions will be terminated. Once again, based on, I'm sure, who owns this, and who can actually even work on these things, it'll get approved. So I don't really think that matters all that much. The company reserves the right to cancel or terminate it. Blah, blah, blah. So this is where they're just saying that the company intends to file a proxy statement and proxy card with the SEC in connection with its solicitation of proxies for the special meeting to approve, among others, the transactions contemplated by the purchase agreement. And they just recommend that the stockholders are strongly encouraged to read the definitive proxy statement and any amendments and supplements therein. So if you are involved, make sure that you pay attention to that. And at some point that will come out. They'll release that on the main page there. So that's what that one said. And then this is just a 14A, which has to do with more about how some of these deals between these different guys went. So this is similar to what it was saying before in the other one. Is this the exact same thing? No, this is a little different. Maybe it's not. This all looks the same to me. All right, so either way, I think it was a separate filing, but it was kind of included in the idea of what that was. Yeah, because this is all the same. So either way, you know, so I kind of took that from what I can tell. Me just update this just so I make sure I got the most current stuff. But I think most of us are in agreement on what this means. Courage has wrote about it. Apparently he kind of did something similar. He said he just took the hit, apparently sold, and then at 24 got back in, and he's planning to exercise the rights. And the reason he's saying he's willing to exercise the rights is let's say you bought or owned 100K of shares. You know, you get the right to buy another 1.6 million shares at 5 cents. So if you just do some simple math here, and this is kind of what I did to, you know, calculate in my head how much money I needed to be able to do to make sure I could participate in the rights offering. 100K in shares equals 24K plus another 80K to buy the 1.6 million shares. So however many shares you have, make sure that you can figure out what the number is to make sure that you can buy the next chunk of shares, or it should be at 1.6 to whatever you have at 5 cents. So I think it's per 1,000 would be $840. The new cost basis is 0.061. So with 2.6 billion shares at 6 cents, it's only 158 million. The balance sheet is now fixed, and they should win dozens and dozens of new FTC contracts. So the value of the stock is the value of your rights. Even at 40 cents, you own the stock at 7 cents if you're a new buyer. If you have no exposure, you should load up, or you load it up, whatever. If you own it at $1, taking up the deal is at 10 cents or a $275 million market cap. So he's saying now they have tons of cash and a termed out ABL. So like I said, that stuff all ended up working out in the benefit of BNED. So like in the long form, it is in a good position now. I mean, they really cleaned up the balance sheet. It's just this initial equity dilution's killer. And then figuring out in the long run, you know, like what that's going to be worth per share. And then I saw a few people bring up the fact that obviously they could do a reverse split here at some point in order to regain compliance. So we'll have to see how it all pans out. He goes to continue and say the business is clearly inflecting. There's a ton of schools to convert to FTC. Bigger issue than the DOE arguably was the balance sheet, the bankruptcy fears. He's like, balance sheet's now fixed at the expense of existing equity holders. That's me. Thank you. Going forward, though, but on a 1.6 billion plus revenue base, there's no reason they can't do 100 million in 2026 EBITDA at 24 cents. If you take up a rights offering, the pro forma enterprise value is maybe 275. The business has a bunch of new equity, no 34 million of second lien and lower interest expense. This could be a home run / grand slam, depending on your view of the business, for new 24-cent buyers that take up the rights offering. Market has to recalibrate after the supply. So yeah, obviously it's going to take a while before this kind of is fleshed out. We really figure out where this is going to land, what things are going to be worth. You'll probably see a lot of people kind of wait just to see what ends up happening with this and where the price kind of falls. I was just seeing if there's anything else. Sorry, I got to get back to the BNED part here. Not really sure. This X guy, he said I was a short today, and I don't really know what he's talking about. And he keeps having all these memes about how the shorts are going to be screwed in this, which I don't know what he's saying. Cornelia Research, he's another guy that's has been involved in this. So he said, deconstructing the deal, it's clear that the senior lenders required 34 million of second liens to be taken out or equitized. Yeah, this is more what I was thinking. We had thought it was in the range of possibilities for this loan to be merely extended out long past the maturity of the first lien. So once that was required, 34 million refi versus 50 million equity market cap, the game was up and dilution would be substantial. Relatedly, we knew the existing shareholders would likely step up to back up a more reasonable rights offering at 75 cents to $1, but that also didn't materialize. So, and he's like assuming most of them exit now. I'm assuming most people probably jumped out if they were already in this, just especially on like the news that it was going to be diluted by, you know, 1 billion shares or more. Because don't get me wrong, it's, you know, it's not what you want to see. So for the new money equity guy to step into this mess with opt-in, opt-out not resolved requires a pretty big price. IMMR is essentially a patent troll with licensing business and just 15 employees. We have a $50 million buyback in place. It's a real bet for them with at least $50 million out the door. And whatever they get hit on with the backstop, the $20 million of fees as part of this total transaction. It's 4.4% of deal value and likely will get split between the ABL and IMMR. And then he's saying doesn't really matter if the stock's at this point what the price is as post rights exercise. You're paying 5, 6 cents, 6.5 cents. Obviously a reverse split is coming, by the way. He says that and like I said, somewhere else I read someone saying that too. So and that's an argument for compliance. So whether that happens, I mean, I would think it would have to keep your share price above $1. But I'm just not sure with all this going on how much that affects the actual licensing thing. Expect to see a combination of capital out the door for the rates and the pain of the deal to move the stock closer to 10 to 15 cents until the deal closes. There'll also be a lot of legacy holders to sell / not exercise. Post-close, this is actually what you wanted from the beginning. They did raise the capital that was required. So now you have a so far of 250 for when the ABL is due in 2028 with 100 million of availability, 80 million of cash, and a growing FTC business, which he says is kind of the question here. And obviously it goes back always to the opt-in versus opt-out. If you keep opt-out, I'm assuming he means opt-out, this can work from here. Which, I still argue in the opt-in, this could still work. So we'll have to wait. They have a poison pill through January of next year, which caps people at 10%. This will make it hard for real guys to care. He said, we'll just have to see where everything ends up. 2024 guidance is 40 million. Hopefully we see 60 plus next year. Competitive dynamic will be interesting. Does Follett raise capital too? A lot of unknowns. The biggest is still the Department of Education. He's this Dan guy's saying that it's crazy that a big part of this is going towards fees, but I feel like that's just how these deals work. So So I don't know. I think that's everything that I see on BNED on Twitter here. There's a bunch of new comments. I'll give it to Henrik. He was right. You know, he said that they did talk about the possible substantial dilution, and he was right there. That's ended up being what happened. So, you know, I still stand by. I really didn't think they had to go about it this way, but obviously I'm not in the meetings, and I you know, there's nothing I can say or do at this point. No, here they're just talking about, because this is kind of the way it was written, it was confusing. He's saying the second one's the real rights offering, and that's about the 900 million shares. Yeah, so at this point, you know, if you're still in with BNED, you really have to consider putting extra cash in after the rights offering, because or in the rights offering, I should say, because at this point, there's not really going to be a way to escape the dilution that's occurring. You know, it's not like the stock's going to materially change in the next, you know, little bit of time here for a long time. So we'll see. Obviously, this is going to drag on even further with everything going on. So I feel like, you know, I'm okay with where I'm at right now, because I did adjust, and, you know, I say my portfolio's down, and I guess if this was to bounce back over the next year or so, and, you know, I do participate in the rights offering as you know, I'm planning on right now. That's what I'm planning on doing. We'll just have to see where it goes from there. You know, if they really do have a good year or so, and we continue to watch the FTC program really expand and thrive, that's the most important thing, I guess, going now. Which, you know, it was obviously just not the right way of getting here. It's tough. It's tough to see it down that much, and I just feel like I saw a bunch of different things that made me really think. You know, I guess I was technically right in the fact that I said the one concern I did have was with a large equity dilution. I just didn't think they would go with this large of an equity dilution. You know, like I said, I haven't been investing for, you know, I've been investing for a few years, and I usually don't see one where a 50 million share all of a sudden has, like, you know, 2 billion shares. Like, that's an insane amount of shares that they've released. So, you know, we'll have to calculate what those actual numbers will be. Like, that's what I'm saying. Like, all this doesn't even matter. That's why before I wasn't really relying on this too heavily, like I do for most companies, or even some companies, because the numbers are all going to change so much that, I mean, what does it matter at that point? Like, yeah, I can't even type the numbers in, because it's not going to matter right now until we get an actual filing that has everything kind of finalized, and we can really see where we're at, which I kind of think is what's going to happen anyways with the markets. The markets are going to want to see where this lands before anybody touches it again at this point. You know, I mean, you know, if you are interested in a possible rights offering, I could see maybe some people hopping in here, because at this point, you know, for every 1,000 shares you buy, you can hop into that. I don't know. We'll see who does. And obviously, if they don't buy it, some of the other guys will buy it. So, I'm trying to think if there's anything else I haven't looked at that would have some kind of news. Oh, you know what? I didn't check Reddit. Let's see here. Yeah, and I think on Reddit, from what because I had seen most of these posts, and I was kind of in the same agreement. So they're saying you get the rights for 18 more common at 5 cents, and when I did the number, it was 16.8, I think, is what it was. But whatever, it doesn't really matter. So they're saying like their effective cost basis for 19 shares will be 6 cents. Oh, low pose. This is who had mentioned the reverse split here. Yeah, so it looks like everyone's kind of in agreement here that the only real way to play this is to somehow do to participate in the rights offering, because otherwise you know you're gonna go from 50 million shares to 1 point is it 1.6? I don't know. It's a lot. There's gonna be a lot of shares now. So the equity is gonna be, it's gonna be a really, really small piece of the pie here compared to what it was, even now. So let's just check Yahoo. I don't think anything really changed here. And I mean, at this point, the stock price, like they're saying, doesn't really matter, because it's not whether it goes up 10, 5 cents down. It doesn't matter. I mean, you're either going to get in here and you're going to take advantage of the share offering, or sit on the outside. All right. Yeah. I don't think there's anything else. To go over on BNED right now. So we'll hop back to the dash here. I do have to go through the movers and stuff from Monday. We'll see if we can find anything. But yeah, so hey Robert, we were long on it. If you haven't tuned into the stream, our whole point that we thought what was going to happen is, we were more focused on the fact that they would avoid bankruptcy, and we've been pretty bullish on the whole DOE proposition. We listened to I listened to the actual meetings live, and I thought even in an opt-in scenario that BNED would be okay in the long run, but it looks like and part of my thesis was that the dilution wouldn't occur, because you would have to dilute by so much that it wouldn't. I'm still in, Robert. My goal is to take part in the equity, the rights offering. I did have to sell part of my position today to make sure I short up cash, to make sure I can take advantage of that. So I did have to sell some of my position, just to be clear. But I still have money left over that would basically allow me to participate with the amount of shares I have for the actual dilution for the equity offering. So it's still a loss for me at this point, obviously, but I'm still long on the business. Obviously, we'll have to readjust with things, because as all these numbers change, I'm going to have to revalue what I think the shares are actually worth. Do I think equity is going to be in a good spot by the end of the year? Because that's my big concern is now that. But yeah, I don't short anyways, Robert. I'm not really someone who would short. If I might do like puts or something on something if that was the way I wanted to play it, but I don't really go short on a stock. But Yeah, it's tough to say here, and like I said, I didn't expect this kind of dilution. I wasn't expecting 1 point some billion shares. Like, that's insane to me. So, but as I had said earlier, and I think some of the other guys have commented on here too, it was obviously that the second lien needed to be paid, so they had to do something to amend that. And I mean, now they do have the ABL facility that's kind of revamped, so that's good. The balance sheet is probably going to look much better now going forward. It's just that there's going to be so many shares. So if you're doing anything on some kind of share type calculation, obviously the dilution here is going to hurt that. So my big issue with this then is it's going to drastically limit what I thought the upside was for equity, just on the fact now that you own such a smaller portion of the pie here. So not obviously not the news like we've said. It's not the news I wanted, but I still think there might be some kind of silver lining here. So we'll keep looking into it. We'll obviously I'm going to be following it very closely. I've been following it this whole time closely, but I think with everybody putting money into it, they obviously must think that the business is going to survive too, which is, I mean, I've always thought it's going to thrive. I thought the FTC model was great. I thought things were looking good. Even, like I said, even in an opt-in situation, I still didn't think that was necessarily a bad thing for the business. Not as good as obviously continuing an opt-out, but if it did transfer over to an opt-in, I didn't think that would necessarily screw over the business, just because I think they would I still think it sounds to me like it would be mandatory because of the way the programs work, because the schools are mandated to make sure that they provide the textbooks within 10 business days of the payment period, and they have to be able to provide them to all the students possibly. So as an institution, you would think that you'd have to, if you have 50,000 students or whatever, and even in an opt-in situation, if everyone opted in, you'd still have to have access to 50,000 textbooks within 10 days of the payment period. So in order to stay in compliance with that, you have to consider the fact that there's a chance that everyone would opt in. So if that's the case and everyone opted in, one easy way to stay in that compliance would be using FDC and models like that. And like I said, if a bunch of schools did this, then you would see BNED drastically benefit from that, even in an opt-in, because even though there'd be a lower amount of students that opt in versus opt out, you'd be across so many more schools and whatnot. And like I said, it would make it almost mandatory. Yes, it's not physically saying it's mandatory, but I'm not sure what you mean. Why can't they profit? Because I am saying I think they would profit. So I mean, it's just the way the models work. It would just be different versus opt in to opt out. But yeah, at this point, I'm gonna hold my position now. Yeah, they operate at a net loss right now, but you have to understand it's an expanding program. And if you just look at the numbers over time, like, things kept getting better and better. Well, so I don't know if you, Robert, I don't know how well you've followed them from the past, but before COVID and all that, they had a legacy business where they basically, they had the bookstores and they were selling textbooks, physical copies of those textbooks. Over time, as things transition to digital and whatnot, that's kind of they haven't been able to make as much money from that, and their sales from the legacy, like a la carte buying textbooks, had started to die off. And then in 2016, during the Biden and Obama administration, they changed the ruling on things, and basically the idea was that they wanted to make it fair and equal for students who are underprivileged to be able to afford textbooks. There's a lot of studies done saying that kids that come from underprivileged backgrounds couldn't afford the textbooks or didn't have good availability for the textbooks because they didn't have like a credit card from someone. So the idea was that allowing the school to have a program where everyone basically would have to opt out of the program would allow them to purchase in advance all these things and get their cost basis down by buying in bulk. So for instance, if your school had, let's say 5,000 kids in a class, like whatever specific class using one specific textbook, you would be able to, preemptively know you need to order 5,000 textbooks, and that money right there would save you. And because most kids aren't opting out, you don't really take a hit on that side of the textbooks that you're buying that, would be unnecessary. And it just makes it for a more efficient business. So what they were doing is that they were scaling down that legacy MBS business, which is the one with the actual a la carte type textbooks. And they were building up the FDC model, which is first day complete, and they were offering that to more and more schools. So even though they're operating at a net loss right now, if you look at like the cash flow here, their cash flow in COVID obviously didn't help anything during all this anyways. But the old legacy building or business was doing very well. But then through COVID, things got real rough. And then they started, they had this huge loss in 2020 during COVID. But then they started to adjust the way that they were doing things, and they started scaling in the FDC model. And you can see just in this recent year, the FDC model, at least on an operating cash flow and on a simple free cash flow, became positive. Now, their earnings weren't quite positive yet, but the amount of FDC schools, so I think they have 1,200 bookstores that they're involved in. Some of those are physical stores, some of them are digital stores, but they were slowly adopting that FDC model to those stores. As that got to a certain point, like I think it was at, around like 200 or so stores, and at the time I think they had like 170 last year or something like that. Once they got up to above 200, they would start to generate earnings on some of these things. The whole cost of the business is a lot easier in the FDC model. It's a lot better for not only BNED, but it also, in my opinion, from what I saw, it really lowered the cost of textbooks for students. I actually just saw something today that one of the only things that was down heavily this year from inflation was textbooks. So the model has been working, which is why there's a lot of argument on when the Department of Education was talking about changing the model. They're like, this model has been saving students money. Why are we talking about changing all this right when, we actually are for the first time really saving students money? You look historically, the price of textbooks kept up with inflation, or at least where it was actually higher than inflation for like literally decades. And then in the past like 6-7 years, it was the first time it was less than inflation. So it was actually, it was becoming cheaper for the average person. So that was kind of the weird thing about the Department of Education coming here. And you saw some people talk about it, like they're nitpicking this, but for the price of college and all that, nitpicking and nickel and diming on textbooks isn't really going to change much. But either way, so that's why, in my opinion, going forward, as the FDC model grows, this will become earnings positive. We were projecting basically that by this fall, that quarter would be net earnings positive for the company. And so going forward from there would only continue to get better. Now, the issue is before that could happen, they had a debt amendment that had to be fixed by December of this year. Now, that's where all this came in, is they had to amend that credit. And this is what we've been following now really closely to make sure that they amended this credit. But the worst part is that where we were hoping that they wouldn't do some kind of stupid dilution here because it would be a stupid amount of shares, which is what it ended up being, we were thinking that they would either sell part of the legacy business or sell some of their contracts or something else to raise that money. Either that or they just do a straight refinance with the second lien loan there and push that out further, and maybe or offer some form of collateral on that. But either way, obviously that's not what happened. So here we are, and there's going to be a rights offering. So if you are involved or you're thinking about getting involved down here, just make sure you have enough funds to really take part in that equity offering. Because if you don't, you're going to get diluted, So with this, they'll cover the debt that they need to have covered right now. They will have an ABL facility, which I think said it's over $300 million that they can pull from. Because of the way their business works, 2 of their quarters are super profitable. The other 2 quarters are just less profitable because the 2 quarters, one's this fall and one's the spring semester. So obviously that's when most college students are buying their textbooks. The other 2 semesters, obviously you're just not going to get that much funds coming in. So during that time, just to provide liquidity, they basically use that ABL facility just to kind of get things through. So the good news is they'll pay even less on their interest going forward. In their balance sheet, they're going to have less debt to even deal with. They're going to have more cash on hand because of what's going to be raised here. So after this dilution right here, I don't think there's going to be any more dilution after this. You already diluted as much as you can. It's going to be tough for them without doing a reverse split to get the stock price back to somewhere reasonable. You said, what will be the price for the equity offering? So the equity offering, Robert, because it's a rights offering, works kind of strange here. I'll just pull it back up just so you can see it because I had it here earlier. So this is the thing. Actually, you know what I'll do? I'll just show you the math because what's his name had pulled up the math here, and it's just a little easier to see it as someone who's a shareholder. All right, so, well, this is the thing, Robert. You have to own shares to take part in this equity offering because it's not a typical equity offering. It's a rights offering. So let's say you bought or owned 100,000 shares, and we can shrink these numbers down. But either way, you get the right to buy another 1.6 million shares. So 100K shares at the 24 cent price that you're talking about right now, he would say equals 24K. You'd pay another 80 to get 1.6 million shares at 5 cents. The new cost basis would then technically be only 6 cents per share. But this is the issue, Robert, is that you have to make sure that you have money backed up. And I think you have to have, for every 1,000 shares, you're allowed to buy 16,000 shares or whatever it is at 5 cents, which came to like $840 if I calculated it correctly today. So for every 1,000 shares that you own now, if you're going to pay 24 cents for it, make sure you have that money to buy the additional 16,000 shares at 5 cents. Otherwise, as it gets diluted, you're going to be stuck with those initial shares at 24 cents. And even down here, you kind of get... Alex, someone had brought it up in here that... So this is the thing, guys. Like, if you are interested in this, you basically, whatever you pay right now doesn't really change that much. Because if you're paying 24 cents to get in your initial 1,000 shares, or you're paying... what do you call it? Or you're paying 22 cents or 18 cents. Yes, that stuff will help you, but the real benefit is the fact that you're buying that next 16,000 shares at 5 cents. It's that 5 cents that's going to really, really drive the cost down. And that's what everybody who's involved in this deal is, all the different, either companies, they're all getting it at 5 cents essentially on this. And that's where the real money is going to be raised for this. So you want to make sure, no matter what, that you just do your math and make sure that for every 1,000 shares you can afford to buy the dilution that's going to occur, or the offering. So, and it's like I said, it's basically 16. Per one share, it's 16 shares, just to make it easy. So if you own one share, the problem is you have to own 1,000 for you to take part in the offering, I believe. I'm pretty sure that's what I read correctly. So no matter what, you just have to make sure that if I'm in with IBKR, why not just short the stock if it will go down to 5 cents? I'm not sure what IBKR is. And you're saying that the stock will get shorted down to 5 cents, but that's not that the stock's going to drop down to 5 cents. That's after the offering. So it's not like you'd have to short 1,000 shares and then hope it doesn't, go up at all. Well, it's not that the I get, okay, interactive brokers. I get you. So it's not that the dilution, I mean, yes, the dilution's priced in the fact that, like I said, it's down to 24 cents or whatever the heck it is now. It's cheap. So that part's priced in. Like I said, this is going to bounce around. I mean, like, it doesn't really matter. It's just knowing that if you want to get in afterwards, then and to your point, Robert, I think Henrik was saying that he is shorting it. Like I said, I don't really short. I'm not much of a shorter at this point. But let me just scroll down. So this is to answer your question, Robert. So he says your calculation may be correct, but it doesn't mean anything because it's pretty clear that the stock would not hold its current price post dilution. If you're making these calculations within the context of shorting the stock now, then wouldn't you be short the rights as well? I'm not too familiar with the intricacies of shorting with the looming rights offer. And he said, yes, I am also short the rights in this case. So I think you could short it here. It's not to say that the stock price might not go down very much. Like it's going to be diluted down to 5 cents. So that's different because that's a rights offering that those shares are sold at 5 cents, but that's not open to the public. So that's not the price of the stock. And then once those shares are out there, it'll be different. Because like your shorts would be diluted in the, like you wouldn't have a lot of shares going forward then. But Hendrick still says that he's also short the rights in this case. So maybe I like I said, I'm not super good with the like he's saying with the intricacies of a rights offering. I'm not 100% sure if you're shorting it how that would work out, but I don't think the stock price will go all the way down to 5 cents. I just don't see that happening. But either way, yeah. So I would just say I'm sure if you look that up, you can find a better answer, Robert, than I can give to you. I don't want to tell you the right or wrong thing either way. So, but something to consider if you're someone who shorts things. You might be able to pull that off. Well, so Alex, that's another thing too. So they already have gotten their NASDAQ listing requirement warning, or I think it's New York Stock Exchange, but either way. That was already listed out there. So that's why some of the people on some of this has been saying that the problem is they're going to have to do this dilution and then possibly do a reverse, which is why it's even more important to make sure that you participate in this dilution if you're going to. The other thing, Alex, too, is you could follow this and just wait until all this is done and then buy into the business afterwards. I'm someone who's been long on this for a long time, so I'm kind of already involved. So for me as an existing shareholder, it makes sense to hop in with this dilution, because without that, my shares are going to be, basically diluted into nothing. And if that's the case, in my position, I would think the best thing to do would just be to sell out and take the loss. I don't know if you guys have watched the stream all that much, but we typically we go into pretty risky stocks with these portfolios. Like that's kind of the goal of these portfolios. To be completely transparent, I have more than one portfolio. This is just one of mine that I tend to take riskier positions on. It's usually all micro cap stuff that's usually highly distressed, and so like I said, the point is to have outsized returns. Obviously, this one did not work in my favor, or so far has not, but I wouldn't, just necessarily recommend, without doing some serious due diligence yourself, to understand what's going on here, because there is a lot, and obviously we're going to be wrong on these things. Yeah, I would argue that that's your best bet going forward if you're going to, just because, like I said, this could continue to. Who knows what could happen here? I mean, they even had to put as a disclaimer that there's a bunch of chances that this could be that it's subject to the approval of the stockholders at a special meeting to be held by the company. If the issuance and sale of our common stock pursuant to the rights offering and the transactions are not approved at this special meeting, then the right offering will be canceled. Now, I don't picture that happening, but I'm just saying there's a lot that could happen. So you don't want to assume anything in these. Which, we had a bunch of assumptions, but like I said beforehand, and we were just wrong in the fact that, like I said, I didn't think they would dilute like this. I guess this will be a good lesson for me to remember that never assume they won't give up on equity. I knew that equity, no one really cares if you're owning a business. I mean, yes, some people are shareholder friendly, But when it comes down to it, you know, the lenders are the ones who can bankrupt you, and you have to make sure that they're approving of whatever these things are. And like I said, I was thinking that there was going to be a sale here, because I thought the contracts and I thought the MBS, the legacy business, was worth quite a bit. So I just thought they were going to sell that business off and just stick to the FTC model with the successful stores that they were in. And obviously that wasn't what occurred. So who knows behind closed doors what actually what happened, and whether we were close to that or not. We'll never know. But at this point, we'll just have to move on. We'll have to contemplate from here. And the rest of my portfolio right now in this is doing okay. The problem is those positions now are smaller. So this took up a huge part of my my portfolio for this kind of portfolio. So well, we'll just have to move on. Is what it is. Thanks, Alex. I appreciate it, man. Always appreciate the comments too, guys. You know, it helps to have someone here just to bounce ideas off of too. But anyways, we can go back to the dashboard here. You know, if you guys have any more questions on BNED, just throw them in the comments, and I'll keep answering them, because, you know, it's been on my mind, obviously. So, you know, that's what I'm willing to talk about. But otherwise, there's always other things to look at. So we'll keep moving here. So these are daily movers. This is from Monday, which I didn't see it didn't look like there was a lot of movers on Monday. Since some of you guys are newer that are in here, these are 10% movers, so it had to be up at least 10%. And some of these have been up 10%. This one's up 30%. These are multiple days in a row. Typically, too, I'm looking at value stocks, and usually deep value stocks, something that's most people won't touch for good reason. But I'm not seeing if anything really here is catching my eye. We'll go to, so this is the daily movers, but these are the losers. So these are down 10%. And just see if anything catches my eye here. See what Kazoo's doing here. Start to come back down here. I really think that bump was all just on the news as they were pivoting the business a little bit. So I don't know if there's much more there right now. I tend not to involve like some of these Chinese ones. They always look good, but then I just wonder how much I can trust some of this information. Let's see. Some miners, Bitcoin miners at that, so not really my thing. Like Mullen, here's another one that like holy dilution. Mullen's one that's diluted people to death. Oh my god. And they've done it like multiple times. CMTL. Did I just look at these guys? This is getting stupidly cheap looking. We're down to $2. It's extremely oversold. I just looked at them on 4.2. And I said they have poor fundamentals, high debt. They did pay a dividend. And I said, too expensive, huh? I wonder what too expensive is. I'll pull them in. We'll see what's going on with them. Allbirds was up, huh? Not really. Bouncing off bottoms, though. Yeah, Alex, I have looked at WOOF not that long ago. I can pull them in real quick and just see where everything stands with them. I think my thing with WOOF, you know, and I do think they're cheap down here. I'll see what my valuation calculator even says, which my valuation calculator is kind of crude, but either way, my big thing with them too is with all the actual retail stores, like I don't know how much of a benefit there is. You know, I get this could be worth under $3 to be honest, all the way up to $3. So, you know, $2.50. Now, granted, they are almost free cash flow positive. They are on like an average, and they do still generate cash flow from operations, but their earnings is killing them. Yeah, I mean, this is what's killing me. I mean, you know, you got your net income was minus 1.2 billion. You know how, I mean, you even if you're in a decent situation here, that's gonna kill you pretty quickly if you continue that. They don't have a ton of cash. This debt is starting to become an issue, and they have a lot. They have a you know, $3 billion in debt. So in this 326, I'm assuming most of this is operating leases, but this is a tough one. This is a tough one to see if it's gonna make it or not. Let's see if anybody's talking about this right now. Yeah, this guy says staying away. All right, here we go. Here's a distressed analyst, because he's actually, you know, figuring out if there's imminent bankruptcy. Yeah, Alex. I think it's more. I can't remember. Let me see when the actual debt is due, because that's a big part too. Is when it's actually due here. And normally, I mean, this is one of the first things I usually check, is just to make sure. And actually, so how much are the leases here? So, I mean, almost half of it is operating leases, so it's not like it's true debt per se, but this is their senior secured, which that's just the percentage. Outstanding principal balance of the first lien term loan was 1.5 billion. You know, pretty high interest rate. I mean, it's this environment. This environment's tough on these companies that were really levered. You know, they probably for their almost entire lives. Although this one didn't have a ton of information, so I don't know if this was like, when I look at my fundamentals here, this only goes back to 2019. I feel like Petco, I don't know if they restructured at some point or whatnot, but like they're definitely older than 5 years. Petco's been around for I don't even know how long. I mean, I don't know how many, like you know, he's already saying total debt of $3 billion is very high, but like I wouldn't really count the operating leases long term wise in that number, so I don't really like that number there. I mean, all he's saying is that, you know, he rates it around a 3 or whatever. So whatever, that doesn't mean anything. But, you know, he's just saying, yes, it's distressed. Yes, we can all tell it's very distressed. I mean, that's where they're at. You know, you're going to see this kind of sell off as things start to get close here, which is what I was trying to do, was actually pull up, like I said, when is this due? Maturing on March 4, 2028 was the first lien term loan. And their credit facility is in 2026. So by 2028, they have to make sure that they can either refinance that or adjust it. Now the problem is they have 1.5 billion and they have 4 years to do it. And I mean, they're not generating anywhere near close enough cash for this. This right here is my leverage calculator. So this is similar to like BNED. It's saying that this is probably going to have to be heavily diluted for them to come up with the cash to pay this off. And don't get me wrong, this isn't like a die-hard thing in terms of what it's worth, but it gives you an idea just to say, hey, this could possibly be heavily diluted if they need to raise money through equity, and that's due to the I give a substantial discount. I think when I offer shares here to get to this 1 billion number, it does it like at a 40% discount, assuming that there'd be a large sell-off. Maybe, I guess I should argue after BNED I should go up to 60% for a sell-off, but yeah. So I think this is one that even me as a distressed investor, if you're looking at this one, you're gonna want to wait to see more here. Now I'm not saying it can't pop in the meantime. There's gonna be noise and whatnot, but I don't see anything coming here. Now I would highly recommend, Alex, if you really want to see what management's doing, is looking at the most recent transcripts and then also going through the most recent filings for the last year, just to kind of see what management's trying to do. Because unless you have that information, but even for me right here, this would have to be quite a, I don't know. I would just need more of a catalyst with this on for some reason why this is going to turn around. Now, one thing you can think about too is what is the actual assets here? Are they able to sell anything? If they were to eliminate some of their underproving stores and increase their margins and then lower their operating leases, could they pay that debt down faster? Like, these are all things management needs to be thinking about right now. And until they do, this one's tough. I mean, that's a lot of debt. That's not a great enterprise value. So I would say even this one's a little risky for me at this current state. Don't get me wrong, it's cheap. I mean, you could argue it's cheap on a bunch of different metrics. So it's like I said, it's in my database, so obviously I kept an eye on it, and I gave it a 3 in confidence, which means I'm confident that it's probably not going to get out of this, but maybe, you never know. Some of the, I mean, these are the kind of things that, especially when the chart starts to take a nosedive, that if something turns around, if there's some kind of good news, you can watch these things really pop back. But like I said, now we're talking, the Fed's talking that they might possibly, people are arguing that they're not going to actually drop interest rates, which for, some of these companies that are so highly levered, that'd be like a godsend for them. And now it's looking like you could argue they're going to raise rates still. So I don't think they're going to raise rates anymore. I think the economy's pretty fragile, already is. And I think with the election coming up, I don't think they would dare to. But you never know. It's not their job to, just appease the Fed. Or for the Fed to appease the rest of the government there. But I'll keep moving on here. I'm just seeing what's going on with Bird, see if there's speaking of having an issue, they got to get their stock price back up here too. I don't think there's much to see with Allbirds right now, so I was hoping there would maybe be some kind of news turnaround to see that 10% jump, but I don't see really anything there. They're another one too that it's not really generating any kind of cash flow, so without cash flow, it's meh. motor car parts. That's the name of them? I feel like I've never heard of them. What's going on with these guys? Alright, well, this one's interesting. Oh, I have looked at them. Okay. It's been a little bit. Oh, shoot. I meant to hit disable here. This might lag a little bit because it's going to try and pull in the fundamentals for all those because I forgot to disable that, but oh well. What else is going on here? Anything? Anybody good? Yeah, I'm not seeing too many other things. So only a few tickers are popping up today, which whatever. We'll go to the insiders. Let's see what's going on. Anybody buying that's interesting to me? Is Carbide still down? Yeah. Wow, they're still plummeting, huh? It's a rough backdrop for them. We looked at Mastercraft last time. I thought that was an interesting stock. Kind of cyclical, but I thought there was kind of something there. And some of these other ones I haven't really seen. Yeah, any EVs? Honestly, I kind of agree with you on that. I think the issue is I think the next bullish catalyst for EVs is going to be some kind of massive improvement in the batteries. Whether that's a different material, I think like we're at like phase one of electric cars and whatnot, and I think that if you talk to like the average person that's going to see a negative with an EV, first off, is it depends on what the price of gas is doing. Obviously, more people will be involved with EVs as the price of gas goes up. So things are climbing right now. I feel like you'd have to see a bigger amount change, but lithium right now seems like a race to solid state. Yes, yeah. I mean it. And but like if all of a sudden you get cars that can go 500 miles or more on a charge, and that they can charge up in 5 minutes, I think once you see those kind of improvements come, which I do think are coming, I think that's the next time when you'll see like the EV market just explode, because all of a sudden all the real inconveniences that come with an electric car just kind of disappear. You can argue too, and this isn't me saying this. I've heard a lot of people argue that everybody started making all these EVs. You got every manufacturer, after watching Tesla be successful with it, started this whole EV program, and the market kind of got flooded with them. And there's only so much demand right now, and like I said, I think it's due to the fact that like if you only have one car and you live any bit rural or something like that, or you do travel long distances ever, like if the long distance becomes an issue for you, like you're not going to buy the EV, you're going to buy the gas power, or you're going to go with a hybrid if you really care. Hybrids you can argue are a little more expensive, but RIVN's one of the ones that's getting started, but it's just they're still pretty new. I try to find stuff that has a little bit longer history in terms of sales and whatnot than like RIVN does. I mean, they're getting there. They are starting. And Tesla was there too. So I haven't like done too much looking just specifically into EVs, but it's not to say that I don't think there's probably some interesting players there. I think, Alex, that it's going to have to drop a little bit more for me to want to look into the EVs right now. Not to say it's probably not a bad thing to start looking at some of them now just to get an idea of where things are. But maybe we can just pull up and see what kind of numbers we're getting right now, at least on a base level. The other thing too, they're a little big for me. So and when I say big, I mean market cap wise. I tend to look at more small cap and down, and that's really just because, like I said, I'm looking for outsized returns. So you know, RIVN's one of those ones though too. If all of a sudden they become like a super successful business, like yes, you could see them. You could see this market cap go from 8 billion to 80 billion. You know, I'm not saying that can't happen with a company like this, but is it going to happen right now? I don't know. And I mean, there's a few people I see some RIVNs driving around me. I mean, they're it surprises me every time I see one, because I'm like, oh wow, I'm surprised someone has a RIVN way out here. But yeah, I get them just a little expensive right now. And you know, this is like when I'm looking at these numbers too. Like you can just tell they're such a new business. They're just burning cash right now. They're just trying to get on their feet. You know, these margins are still, most of these are all negative, and don't get me wrong, some of them are improving, but they just have a ways to go. I mean, look at this revenue increase. I mean, don't get me wrong, this looks super bullish. That's like 3 times in 1 year, you know. So who knows? Maybe they'll continue to grow to where they need to. And you know, if we're looking here, I mean, they got a lot of money still on the books. They don't have a ton of debt in general in comparison. I mean, they do have, you know, 5 now, but they have 7 billion in cash, almost 8 billion in cash. And they have diluted shareholders, you know, steadily here. But as a growing new company, do I think it's insane? Not really. I mean, you know, this is why I typically don't get involved in these things just yet, because there's so many variables that I can't account for. And I feel like when you're trying to value invest, the more things you have to throw in, the variables straight up unknown. Like, I don't know how you can trust your valuation too much on that. So my issue with this is it's just young and unproven, essentially. And I mean, the good thing too is, like I said, I mean, you know, you go from 55 to 1.6 to 4.4. I mean, these are extremely impressive growth numbers. So if you're more of a growth investor type, you know, I can see this popping up on your radar. And like I said, they do trade under book right now. You know, and they have a ton of cash. They're actually net cash positive compared to their debt. So it's not like their balance sheet is ugly in any way. It's just at the rate that they're burning cash, how long does that last for before it becomes a problem? And like I said, we're going into like a cyclical market right now for EVs where it doesn't look good on the backdrop. Like the narrative is poor right now. And I'm not saying it's poor as in like, you know, I think the EV market's going to die or anything like that. I think it's just a little overstretched right now. And it's like, it's going to take a little bit for the demand and the technology to catch up. I'll see if someone smarter than me knows or agrees with what I'm saying. I mean, even if you look at the comments here, it's like sell, buy, strong buy, hold, strong sell, buy. So like everyone's all over the place. No one knows. They just got an Amazon partnership. So they're working on charging infrastructure. So that's like another part of their market too, is, you know, someone's got to build out all these EV charging stations all over. So something worth there. You know, Amazon holds a position of 158 million shares, or about 16% of outstanding shares. So I mean, you got Amazon here working with you. It's not a bad person to have on your side. Just there, I just hadn't even looked at the chart here in a while, so I just wanted to see where we're at. So low 30s. Yeah. I just keep seeing this book value. It's going to keep decreasing, and it won't be long. Like I said, where the sad part will be that this debt will start to eclipse these this amount of cash. I mean, they are working on important things. You know, getting SG&A costs down, getting you know, their R&D down. This CapEx is $1 billion. You know, $1 billion a year in CapEx. I mean, that's, for this company, it's a lot. I'm just gonna refresh this just so I can move on to just these other few that I had pulled up. Honestly, there's not too many tickers to go through, so I'll probably just go through these two, and then I'll probably call it the stream tonight. We'll see going forward what ends up happening with BNED, you know. Well, I just got to adjust this here because this is going by yearly. All right, so like I said, I had pulled up Comtech not too long ago. They deal with terrestrial and wireless network solutions in like emergency type situations through a bunch of different services. So I don't know. It's like an important business to have. The ugliest part here is obviously their cash flows. Which historically looks really good. So, you know, for most of the teens, they were positive, and now it seems like over the past few years, things have really been kind of cutting back on them. Free cash flow has been kind of following the same model. You know, retained earnings continues to just plummet. You know, we were up at high 80s before, and then we spent a long time in the mid 40s. And now we have, you know, 4 years of negative earnings. So they I mean, they got to do something to improve that cash flow there. And what is this non-common equity? Would they have preferred shares? Oof, they do have preferred shares. All right, well, that doesn't help either. So not only do they have a decent amount, and their debt's due. Oh, man. What's going on with that debt? This is amended 10Q? That always sounds good. Yeah, they have to amend their credit then right away. What is their actual... They have a lot of preferred shares. That still could be converted. So that's probably what I didn't like about it last time. So he's arguing that the revenue growth has been good. I don't know. I don't know about that. Seems pretty stagnant to me. Unless I'm missing something here. Unless you're just talking net sales. But, you know, a lot of times I feel like when you're looking at these kind of companies too, like it's all like, a lot of it's contract based. Yeah, it should be able to achieve these given the record contracts awarded to the company during Q1, which includes a U.S. Army contract with a $544 million revenue ceiling and a $20 million order from the UK Spectre Group. Does it pull this up when you actually look at this? Sorry, let me zoom in on this for you guys because this is pretty small even for me. It's a 10-year, $5.1 billion. I mean, that's a lot of money. So obviously this is a huge consideration too, and this one is the debt. Like I said, this debt's due, so they have to figure that out. Same story with all these companies. It's currently trading at a share price of $8. What is that? What it's trading at right now? Is this right? $8. This is, what is this from? Wait, what? Yeah, that's what I'm saying. He says it's at $8. I was like, when did he write this? Oh, I just didn't scroll up enough. Oof, yeah, change since he wrote this is minus 75%. I mean, don't get me wrong, that contract sounds great, but the problem is you got so much debt due well before that's going to matter. I mean, where do you come up with the money for this? And they have preferred shares on top of it. Like, you know, as a shareholder, you know, when I see preferred shares, especially, like, because usually, like I said, I'm looking at distressed companies. So if you see preferred on top of yours, like, it looks ugly for equity. Especially because these are convertible too. So you also could possibly get dilution that's not even going to benefit them just yet. Yeah, what's going on here with the so they sold this business for $32 million. Renegotiated preferreds. They gave away a big chunk of the company for that. When was their last earnings? I just want to see what people said during this. Yeah, who owns this? Well, I'm just gonna close out of some of these things here, so I have like a million things open. Magnetar Financial and White Hat Capital are both huge owners, and that's 2 and 3 for them. It's 33% of their portfolio. Man, so between the two of them, they own 20 and a half million shares, and there's only 28 million shares outstanding. Wow, that's a huge chunk of the business those two own. Yeah, I don't know. This one's tough. I don't know if I can see anything here that would get him out of this hole. There was someone who bought. Who is Mark Quinlan? You bought 100,000 shares at $8.89, huh? At $6.21. That is brutal timing. That's like right before it really starts to crash. Ugh. Yeah, I mean like I said, you know, if they weren't so leveraged, it wouldn't be so bad. But man, it's really ugly down here. All right. We'll go on to Motor Car Parts of America. And now this is probably the last one I'll do today, guys, just because I got to get some sleep here. Automotive aftermarket parts include alternators, starters, wheel bearings, hub assemblies, blah, blah, blah. A bunch of car parts. I mean, you don't need to name every car part. So right off the rip, they're improving revenues nicely. Turnover has been slowing down a little bit. Had a rough quarter for earnings here, but they were cash flow positive. But they were negative in earnings, huh? by quite a bit. And yeah, they did go from 19 to 20 million shares, so I don't know if they offered shares there. They're actually paying debt down. CapEx was only 1 million for them. Seems low. Was this the one that I saw? They bought at 750. What's this at? It's at 540 right now. All right, here. Yikes! It's another one that's way down here. So this is, I'm getting 626 as a value for it. They don't pay a dividend. Yeah, let's see if anybody's saying anything about it. Net sales increased 13% to 171.9 million. Gross margin improved by 3.7. Gross profits increased by 43%. Operating income was 170. Non-cash items as well as cash items. The non-cash items reflect core and finished good premium amortization and revaluation of cores on customer shelves, which are unique to certain items or products and required by GAAP. Okay, whatever, it doesn't matter. I mean, not that it doesn't matter, but it doesn't matter. Yeah, they're getting hit by the higher interest margins as well. Continue to work with our customers to mitigate higher interest rates due primarily to the 37.5 million U.S. federal and state deferred tax asset valuation allowed under GAAP recorded during the fiscal 24 third quarter. Income tax expense was 37.3 million compared with an income tax benefit of 9 million for the same period a year ago. So that earning loss is due to the deferred tax there. All right. During the 9-month period, the company reduced net bank debt by 43.7 million to 102 from 146. We expect to generate an increase in operating profit on a year-over-year basis for fiscal 24, supported by growth, generate positive free cash flow. In addition, They're saying total cash and availability was approximately 126 million, where the net debt, excluding their convertible notes, so they're not counting their cash somewhere here that I'm counting. All right. Let's take a look at some of these numbers real quick here. So 12 million in cash, a lot in inventory, obviously. It sounds about right. Convertible notes is 33. Oh my god, these guys have preferred shares too. Does everyone have preferred shares all of a sudden? They're not paying no dividend on it. Oops. Those convertible notes can be redeemed after March of 2026. And man, the interest expense, $3 million right now. And this will be due in 2029, so it's a long ways from now for the convertible notes. All right. Let's go to my database here. MPAA. We'll take that out. Oof, I'm just gonna say kind of needs more right now. I don't know if there's anything else to really add quite to that one. All right. I think that about does that. So let me just save all this stuff so it doesn't get deleted here. All right. And then, yeah, so Johnny should be on Thursday, his normal time. So we'll continue the stream there. He'll follow up on any of the BNED news that's come out from now. And yeah, like I said, we'll in terms of what else to do with BNED at this point, we'll have to wait and just kind of see what going forward those rights offerings become. We'll have to see what the share count ends up being in total. We'll have to see what the stock price reacts to it. And then the other big thing too is going forward into the fall to see how the FTC programs perform and where those actually land. Just see if anyone's... I doubt anybody. I'm probably the only person still up looking at any of this. Yeah, I don't know any of that. I mean, he's just arguing that looking at it on an EBITDA basis, which, you know, I don't really care about an EBITDA basis. You know, I'm wondering what it's going to be on an earnings basis. I think that's, you know, a company to me is where it's substantially more on a true earnings basis than just EBITDA. And when I say earnings, I mean net income. You know, I don't care about, not that I don't care about EBITDA. I know it's just that the number is kind of easily finagled with and whatnot. There's nothing new here. So yeah, I don't think there's anything changing right now. All right, guys. Well, I will probably call it there. Thanks for everybody who's tuned in. Thanks for everybody who's subscribed. We always appreciate it. You know, obviously not super pumped about the whole how BNED ended up. Kind of sucks. Because like we said, we really didn't think this dilution would be that substantial. I guess I should have really paid attention to that word when they used that, because they meant it when they first filed. But, you know, I guess I was blindsided by the fact that, you know, they never mentioned it ever since that first filing there. So obviously a huge misjudgment on our call, but it is what it is. And like I said, you know, as long as you handle the rights equity offering appropriately, you can at least make it through this kind of dilution and hopefully come out on the other side, and we can see BNED actually thrive as a company. So we'll see. There's a long ways to go now. So, you know, that's the other thing too. You know, judge your position size accordingly if you end up becoming interested in it. And always do your own due diligence. Please don't buy any of this stuff on our accounts. Obviously, this was a huge loss for us. So, you know, don't listen to us. Sometimes we're going to kick ourselves because we're going to be wrong, regardless of if we think we're right or not. You know, and you can be right in a million different ways, but if the market thinks you're wrong, you're wrong. So you always got to take that in consideration. But thanks again, everybody. Thanks, Alex. Glad you appreciate you turning in. And I'll see everybody if you tune in. I believe we're gonna do our stream normal time Saturday. Like I said, Johnny will be on Thursday. So tune in for his, please, if you can. And everybody have a great night. Thank you.